Okay, let's unpack this. Welcome to the deep dive, where we take these incredibly dense corporate financial documents and, well, we translate them into something you, the learner, can actually use.
Today we are going deep on Oracle. Specifically, their Q2 fiscal 2026 results, which just came out, for the quarter ending November 30th, 2025.
And our mission here is to find the story behind the numbers. We're looking at a huge surge in future revenue, a really interesting strategic pivot they're calling chip neutrality,
Yeah.
and just a mind-boggling amount of spending.
Exactly. We've gone through the SEC filings, and what you see is a company shedding its old skin to bet big on the future. The headline number, total revenue, was $16.1 billion, up 14%.
Which is good.
It's good, but it's probably the least interesting number in the entire report.
Right, because the earnings jump is where it gets really eye-popping. Staggering, really.
It was, but it comes with a huge asterisk. I mean, if you just look at Q2 this year versus last year, GAAP-diluted EPS was up 91%, non-GAAP up 54%. That looks like some kind of operational miracle.
But it's not. A 91% jump in a single quarter. Something else has to be going on. That's not just organic growth.
Precisely. The real driver behind those huge EPS numbers was a one-time event. Oracle sold its investment in Ampere Computing Holdings,
Wow.
and that gave them a $2.7 billion pre-tax gain. That cash injection is what makes the earnings look so incredible.
So we should almost put that $2.7 billion in a separate box. It's a windfall, a one-off. The underlying growth is still good, but it's not 91% good.
Absolutely. You have to mentally subtract that to see the real operational picture. But the real story, the thing that points to Oracle's future for the next decade, is a number that just dwarfs everything else.
You have to be talking about the RPO, the remaining performance obligations. For anyone new to this is the number that really matters for long-term health.
It's the whole ballgame. As of November 30th, Oracle's RPO stood at an astounding $523.3 billion.
Okay, wait, say that again? $523 billion.
Billion with a B.
That is just an astronomical figure. What's the growth on that year over year?
It's a 438% increase.
Wow.
And even just in this one quarter, sequentially, it grew by $68 billion. They added more committed future revenue in 3 months than many huge companies make in a year.
And where's that coming from? That's not just small deals.
No, these are massive long-term commitments. The company specifically mentioned new deals with giants like Meta and NVIDIA. This is the market basically saying, okay, Oracle, your cloud infrastructure is finally ready for prime time.
So let's define RPO very clearly for everyone. It's not cash they have today, right?
No, not at all. Think of it as a locked-in backlog of future revenue from contracts. It's money they are contractually guaranteed to receive as they deliver services over the coming years. And here's the kicker.
Okay.
They only expect to recognize about 10% of that $523 billion in the next 12 months.
Just a tenth. So this is incredibly long-term customer lock-in.
Decades in some cases. About 30% will be recognized in years 2 and 3, another 35% in years 4 and 5, and the rest stretches out even further. It gives them incredible visibility.
And the confidence to spend money now. So let's look at the now. With that future locked in, how is the current business engine running? What's the revenue mix look like?
This quarter marks a huge milestone. The transition from legacy software to cloud services is officially a 50-50 split. Cloud is now half their total revenue. A year ago, it was only 42%.
That's a big psychological shift. So total cloud revenue, what was the number?
$8 billion, up 34%. But you have to break that down because the two parts of their cloud business are growing at very different speeds.
Right, you have infrastructure as a service, IS, and software as a service, SaaS.
Exactly. IS, which is the foundational compute, storage, and networking, that's the rocket ship, it brought in $4.1 billion.
And the growth rate?
A blistering 68% year over year.
68%. Okay, so that's the story right there.
Yeah.
That's the part that Meta and NVIDIA are buying, the raw power for things like AI.
It is. A teaser of 81% of their total cloud revenue growth this quarter. It's the engine.
And the other side, the applications, the SaaS business.
That's growing more moderately, up 11% to $3.9 billion. Their big ERP products, Fusion and NetSuite, are still doing well, hitting over $1 billion each. But it's not 68% growth.
No, not even close. And for every action, there's a reaction. Where's this growth coming from? What's being sacrificed?
You see it plain as day in the legacy software numbers. Total software revenues were actually down 3%, but the real hit was in new software licenses, the old way of doing business.
How bad was it?
Down 21%.
Wow. A 21% drop. That's a rapid decline. So the big question is, can they hold on to their support revenue from all those old customers long enough to complete the transition?
That is the critical balancing act, and for now, they are. Software support revenue was basically flat, up just 1% at $4.9 billion. That stability, that recurring revenue from their massive installed base, is the financial cushion that makes all of this other investment possible.
And that brings us to the investment. Starting with that Ampere sale. Why sell a chip company for $2.7 billion when your competitors, Amazon and Google, are all in on designing their own chips? It feels like they're going against the grain.
This is the core strategic pivot. Larry Ellison's logic is that designing and manufacturing their own chips is no longer strategic for Oracle. The technology, especially for AI, is just moving too fast.
So instead of owning the hardware, they want to be flexible enough to use any hardware, chip neutrality.
Exactly. The new policy is to work with everyone, all CPU and GPU suppliers. They specifically said they'll keep buying the latest from NVIDIA. The goal is agility. They want to be the best at deploying any technology, not locked into designing just one.
But that strategy requires an immense amount of capital. You can't just deploy NVIDIA's latest GPU without a data center to put it in.
And this is where the spending numbers get, frankly, shocking. Cash used for capital expenditures, or CapEx, in the first half of this fiscal year was $20.5 billion.
$20.5 billion. What was it last year for the same period?
$6.3 billion.
So they more than tripled their capital spending. That is an unbelievable ramp up. Where's all that money going?
Data centers. Every single dollar is going into building out capacity to meet the demand that their $523 billion RPO figure represents. They are building as fast as humanly possible.
And to fund that, they had to go to the markets.
They did. In September, Oracle issued $18 billion in senior notes. Basically, long-term bonds with some maturities going all the way out to 2065.
It's a classic move. They're using massive long-term debt, which is backed by their massive long-term committed revenue, to fund a gigantic present-day construction boom.
It's a calculated gamble, but one they seem very confident in. And even with all that spending, their cash position is stronger. It nearly doubled, thanks to the debt and the Ampere sale proceeds.
So they are armed with capital. What exactly is the grand design here? What are they building?
They're building for a multi-cloud world. The strategy isn't to pull customers out of Amazon or Microsoft. It's to meet them where they are.
You mean letting customers run Oracle's databases inside AWS or Azure?
Literally inside. They are currently building 72 what they call Oracle multi-cloud data centers that are physically embedded within the cloud infrastructure of Amazon, Google, and Microsoft.
72. I mean, the logistics of that, working with your biggest rivals, is it working? Is it paying off?
It's their fastest growing business by a mile. The multi-cloud database business reported an 817% increase in Q2.
817%.
Yes. That number alone validates the entire strategy. It proves customers want Oracle's database tech, but they don't want to be locked into Oracle's cloud to get it.
So how do you even operate a global network that complex and that big without an army of engineers?
Automation. That's their answer for everything. They credit their own autonomous database and autonomous Linux for being able to build and run all this with minimal, as they put it, human labor and human error.
And it gives them a huge footprint.
The biggest, they claim. Over 211 live and planned regions worldwide, more than any competitor. And that global infrastructure is the foundation for their AI play.
Which, as I understand it, isn't just about training big models.
No, they see the bigger opportunity in embedding AI into everything they already sell, into the data center software, into the database and analytic tools, and right into the ERP and NetSuite applications that businesses use every day.
And they're getting traction there. They made a point of saying that all of the top 5 AI models are running in the Oracle Cloud.
That's a huge proof point. They're trying to be the company that can do both the deep infrastructure and the high-level business application and bridge the gap between them.
This has been a fantastic breakdown. So let's just quickly summarize the key shifts for you, the learner. We saw this almost unbelievable RPO backlog of $523 billion, locking in revenue for years.
Then there was the very deliberate pivot away from making their own chips, selling Ampere to gain chip neutrality and agility in the fast-moving AI space.
And finally, the massive investment to make it all happen. A $20.5 billion CapEx surge just this half year, all to build out a multi-cloud infrastructure. a strategy that's already showing an 870% growth rate in that specific business.
It really is a company making a bet on automation, flexibility, and the long-term stickiness of their enterprise customers.
It is a level of investment that is just staggering. So here's a final thought for you to mull over. Oracle is spending billions and reorienting their entire hardware strategy to be chip neutral. They're betting that being ready for any chip is better than being the best at making one chip. Given that level of investment, what possible hardware disruption do they see coming down the pipeline that's so big it justifies this radical all-in bet on versatility right now?
It suggests they believe the future of compute, especially for AI, isn't going to be dominated by a single architecture. They're preparing for a world of fragmentation and specialization. They want to be the Switzerland of the chip wars.
A fascinating thought. We'll leave it there. Thank you for joining us for the deep dive.